If you're watching this, chances are your crypto portfolio has been hurting lately. You open the charts, red. You scroll your feed, more bad news. And somewhere in the back of your mind, there's that one question. Did I screw this up, or was this just inevitable? Well, in this video, I'm going to show you why this latest crypto drawdown was baked into the system from day one, and why DeFi was specifically built to survive and even feed off moments exactly like this. Stay with me. Hello friends, the DeFi Doctor here. As head of education for one of the leading DeFi platforms in the industry with over 4,000 investors and a full research team studying this space every single day, I've seen this movie before. Not once, not twice, but every cycle. In this video, I'm going to do 3 things for you. Number 1, show you why this crypto drawdown was inevitable. Number 2, explain why hold and pray is not a risk management strategy. And 3, walk you through how DeFi is designed to put you in a very different position in the same market. But first, my friends, this is not financial advice and I am not a financial advisor. This is purely for educational purposes. You are 100% responsible for your own decisions. But if you're tired of refreshing your portfolio app and feeling sick, this might be the most important crypto video you watch this year. Let's just start with why this hurts so much for so many people. Most people's crypto strategy looks like this. You hear about Bitcoin or some hot new crypto project. You buy some coins. You watch the price. And then you hope. Hope it goes up. Hope you didn't buy at the top. When the market is green, it feels amazing. Your phone becomes your favorite app. You check it 20 times a day. But when the tide goes out, suddenly you're not just losing numbers on a screen. You're questioning yourself. Why didn't I take profits? Why didn't I listen to that little voice? Why does this always happen after I finally jump back in? If that's you right now, I want you to hear this very clearly. Yes, this is painful, but this is not just happening to you. You are not alone. And this drawdown is not a personal attack on you. What you're experiencing is what happens when you stand in front of a machine that was never designed for your protection in the first place. Let me explain. People talk about the crypto market like it's a moody teenager. Some days it loves you, some days it hates you. But underneath the headlines and the noise, there are a few simple forces that make big drawdowns almost guaranteed. Number 1, liquidity. Number 2, leverage. And number 3, feedback loops. Let's break that down without any PhD level jargon. Number 1, liquidity, the tide that lifts everything. Think of liquidity as the amount of money sloshing around the system, looking for a home. When interest rates are low, when people feel rich from stocks or real estate, when credit is easy, money searches for higher returns. And crypto, with its big moves and big stories, becomes the perfect magnet. So in the good times, liquidity pours in. New retail investors, institutions dipping their toes, funds raising money for the next big thing. Prices don't just go up because coins got magically better. They go up because more dollars are chasing the same numbers of tokens. Now here's the punchline. The same liquidity that runs in fast can run out even faster. Rising rates, scary headlines, funds needing to raise cash. Suddenly that tide turns and everything it lifted starts to drop together. That's not a bug. That's the design. Number 2, leverage, harnessing volatility. Leverage is a fancy word for trading with borrowed money. Margin on exchanges, perpetual futures, loans against your crypto collateral. When markets go up, leverage makes people feel like geniuses. You're not just making 20%, you're making 100%, 200%, 500%, until the move goes the other way. Because leverage works in both directions. When price drops far enough, positions get liquidated, which forces more selling, which pushes prices even lower, triggering more liquidations. That's how a healthy pullback turns into a waterfall. Again, not random, it's baked in. Number 3, the feedback loop. So now you have liquidity leaving, leverage players getting squeezed, fear spreading across social media, and that creates a feedback loop. Prices go down, people panic, they sell, prices go down even more. If you only have one tool, buy and hold and hope, this feels like the end of the world. But from the system's perspective, this is, well, just another day. Crypto is extremely good at doing two things: rewarding people who are positioned correctly in these cycles, and punishing people who only rely on prices going up. So the real question isn't, why did this drawdown happen? The real question is, why am I positioned in a way that this drawdown destroys me instead of paying me? And that brings us to the real problem. The problem with hold and pray in crypto. Let's be honest for a minute. HODL sounds cool on a t-shirt. It sounds strong, loyal, diamond hands. But just hold and pray is not a risk management strategy. Does that mean a long-term conviction in crypto is bad? Of course not. But here's the trap. When your only strategy is buy coins, close your eyes, hope they're up in 5 years, you're accepting 3 hidden risks. Number 1, sequence risk. You might need the money during a bad drawdown. Number 2, psychological risk. You might sell the bottom because you can't take it anymore. And number 3, opportunity risk. While you're underwater, your capital isn't working in smarter ways. Most people don't sell the bottom because they want to. They sell the bottom because their structure gives them no other choice. If all your crypto returns depend on number go up, but then number go down becomes existential. You're not an investor anymore, you're a hostage. And this is exactly where the path splits between the people who only buy and pray and the people who quietly position themselves like banks. This is where DeFi starts to look very different. Let me show you a different angle on the same market. You already know this from traditional finance, but nobody explains it inside crypto. When times are good and money is flowing, banks make money. When times are bad and volatility spikes, banks, well, they still make money. Why? Because they don't sit on one bet and hope. They sell services. They earn fees. They get paid whenever other people need to move money around. Now, translate that into crypto. Every time someone panics and sells a token, every time a fund rebalances, every time a trader flips from one coin to another, that's a transaction. And in DeFi, transactions mean fees. Those fees don't magically disappear into thin air. They go to whoever is providing the liquidity the market is using. In centralized exchanges, that's the platform, Coinbase, Binance, and so on. But in DeFi, that can be you. You can choose to step out of the role of emotional holder and step into the role of liquidity provider. You stop being the customer. You start acting like the bank. Now, I'm not saying DeFi is a magic shield. There are very real risks: smart contract risk, market risk, platform risk. But structurally, DeFi gives you something hold and pray never will. A way to benefit from activity, not just price direction. That's why I say this crypto drawdown isn't proof that DeFi doesn't work. It's exactly the environment DeFi was designed for. Let me make that concrete. When markets are falling, 3 things are happening all at once. Number 1, volatility is high. Number 2, trading volume spikes. And number 3, a lot of people are reacting emotionally. For a pure buy and hold investor, that's pain. For a well-structured DeFi participant, that can be, well, opportunity. Take stablecoins as an example. Stablecoins are crypto assets designed to track a stable reference value. Most commonly, that's the US dollar, though some are tied to other currencies or even assets like gold. They're not designed to skyrocket. They're not designed to crash. They're designed to move, to settle trades, and to keep the system functioning when everything else is swinging wildly. In other words, stablecoins are not a bet. They're infrastructure. Now think about what happens during a crypto drawdown. What does everybody suddenly want? They want to step out of the volatile assets, preserve purchasing power, stay liquid without fully exiting crypto, keep optionality for whatever comes next. That's why when markets fall, people don't disappear. They rotate. They swap out of volatile crypto assets and into stablecoins. And then later, they rotate again. Every one of those moves creates volume. Every swap creates fees. And those fees have to go somewhere. Here's where DeFi changes the equation. If you're providing liquidity to stablecoin pools in DeFi carefully, deliberately, and with proper risk management, you're not cheering for a crash. You're simply positioned differently. Instead of watching your entire portfolio whip around with every price candle, you're exposed to activity rather than pure price direction. Getting compensated when others move in and out of positions. Allowing volatility to become a source of income, not just stress. Is it risk-free? No, nothing in finance is. But it is a fundamentally different role in the same market environment. When panic rises, activity rises. When activity rises, fee generation rises. And stablecoins sit quietly at the center of that flow, not as speculation, but as the plumbing that keeps crypto moving when everything else feels unstable. Now the same logic can extend out to blue chip crypto assets like Bitcoin and ETH, where you can earn yield by providing liquidity or staking. And also to more advanced DeFi strategies that are built to harvest volatility in a structured way, not as a casino. The point is not just do DeFi and you'll never lose money. We all wish it were that simple. The point is, if your entire crypto plan is only, I hope price is higher later, then you are standing in the worst possible spot when drawdowns hit. DeFi offers a way to reposition yourself. From hoping to designing, from guessing to using systems, from always paying fees to sometimes collecting them. And that's a mental shift just as much as it is a technical one. So let's zoom out for a second. This crypto drawdown will not be the last one. There will be others, some smaller, some bigger. Some that feel like a slap on the wrist, some that feel like a knockout punch. And every time you will face the same fork in the road. Path number 1, endure and forget. You can white knuckle your way through. Hope the market recovers. Try not to look at your portfolio. Then when prices are back up, pretend it never happened until the next cycle and the next lesson and the next sleepless night. This is what most people do, not because they want to, but because nobody has ever shown them a different structure. Path number 2, reorient and rebuild. You can use this drawdown as a line in the sand. You can say, I'm done relying on only number go up. I want to understand the mechanics. I want a structure that doesn't collapse every time the market catches a cold. That doesn't mean you abandon crypto. It means you stop treating crypto like a slot machine and start treating it like an ecosystem with pipes, with flows, with toll booths, with places where value is created and captured. DeFi is the layer that lets normal investors step into the roles that used to belong only to banks and big institutions, providing liquidity, earning fees, designing portfolios that can breathe through both up cycles and down cycles. Is it simple on day one? No. That's why we teach it. That's why we have research. That's why we mentor people through it. But the alternative, like doing nothing and hoping this time is somehow different, has its own cost. Let me leave you with this. This recent crypto drawdown, or any crypto drawdown for that matter, is not proof that crypto is dead, proof that you're unlucky, or proof that no one can win in this game. What it is a reminder that markets will always be volatile. Liquidity will always rush in and rush out. Leverage will always turn little mistakes into big ones. You can't vote those realities away. You can't hashtag them away. You can't positive think them away. What you can change is where you stand. You can keep standing directly in front of volatility, hoping it doesn't run you over. Or you can start learning how to stand beside it, providing structure, providing liquidity, and getting compensated for doing so. DeFi won't magically fix everything, but it does offer something rare. A chance for regular investors to step out of the hold and pray crowd and start thinking and acting a little more like the institutions that have been playing this game for decades. If you've watched this far, my guess is you already feel the writing on the wall. You know, simply buying coins and hoping for the best isn't enough anymore. You know, there has to be a smarter way to be involved in crypto, one that respects risk, one that doesn't depend on perfect timing. If that's you, then let this drawdown be the moment you stop only asking, when will the price go back up? And you start asking, how can I redesign my approach so I'm not wiped out the next time it goes down? Because there will be a next time. And the people who use this moment to upgrade their understanding of DeFi, of liquidity, and how this crypto machine actually works are the ones who will be calm, prepared, and positioned when everyone else is panicking again. If this video helped you see why this crypto drawdown wasn't random, and why DeFi was actually built for moments like this, the next question most people ask is, okay, so what does a smarter DeFi approach actually look like? Well, we put together another video that walks you through how institutional style DeFi strategies really work, why most people get them wrong, and how capital can be positioned to earn fees instead of just hoping prices recover. You'll find that video linked right at the top of the description below. Watch that next before you do anything else. As always, this is about education, not hype. Move at your own pace, understand the mechanics, and make decisions you can stand behind. I wish you health, clarity, and good judgment. All the best. I'll see you in the next video.